Hello, everyone, and welcome to the Basepoint Wealth Investment Update and Outlook webinar. My name is Katie Kula, and I'm the Director of Operations and Chief Compliance Officer at Basepoint Wealth. We thank you for taking the time out of your busy schedules to join us. But before we get started, I have a few housekeeping announcements. To protect our privacy, all participants will remain muted for the entire webinar. For those of you joining us via the web conference, at the bottom of your screen, there is a Q&A icon. We will have a brief question and answer period at the end of this call. If you have a question during this presentation, please click the icon, type your question in the window, and click send. Whatever questions are not answered during the call, we will respond personally offline. If you are joining us via phone, or if you have a specific question about a holding in your portfolio or an aspect of your financial plan, we encourage you to contact your advisor directly, and they will be happy to answer your question. This webinar is being recorded. We do have a brief disclosure slide, which you can review in further detail when the replay is made available. With no further delay, I will pass the mic to Alan Wallace and Landis Wiley to begin our presentation.
Thanks, Katie. I'm Landis Wiley, host of the podcast, a partner and senior wealth advisor at Basepoint Wealth. Joined here with our illustrious Chief Investment Officer, Alan Wallace. Alan, how you doing?
Doing great. While the rest of us mortals suffer through the frozen tundra of eastern Iowa, how is the weather in Florida today?
Well, it's about 50 or 60 degrees warmer than I think Iowa's supposed to get over the next week, so it's feeling pretty good.
Yeah, the temperature here is there isn't one. It's like 2 degrees, so that's just definitely not enough degrees. But anyway, and thank you for joining us on your vacation. We hope you have a good time.
Yeah, absolutely. Wouldn't miss this for the world. So always something fun when we get to put these on together. Obviously it's not just us, right, Alan? We got a great team here at Base Point. I think we have a number of people joining us today on this webinar that are clients of Base Point, friends of Base Point, family of Base Point, and certainly probably a few folks that may not know a whole lot about us. So I thought maybe we would just give a little bit of intro to who we are. Cedar Rapids based, Basepoint Wealth. We also have our tax and accounting side, Basepoint Tax and Accounting. But we are primarily a fee-only fiduciary RIA. We really focus primarily on client-centric and team-based planning. And from the investment side, kind of a big milestone for you here, Alan. We just crossed over the 900 million in assets under management mark. So congratulations to you and your team on that.
Yeah, thank you very much.
So this 2025 year in review and 2026 outlook is kind of one of a series of things that Basepoint is putting on for client and just public communication. Some of the folks joining us here today, Alan, may have been fortunate enough, such as it may be, to have joined and heard us on the Point podcast. That comes out monthly. So for those who may not be familiar, be sure to check that out. And we're always looking for topics to talk about, right, Alan? So if there's anything that comes out of this for folks, we'd certainly welcome those. Looking ahead over the year, anticipate some quarterly market updates coming out of the investment department from Alan and his team. And then we're going to be rolling out a new website here upcoming the next couple of months that we're really hoping will go a long way in helping further the communication that we can put out to the public. So be sure to check us out, tune in whatever way that you can. We always enjoy sharing information on what we're seeing and thinking and experiencing in the world of wealth management. So without further ado, kind of the outline of what we're going to try to cover here today. We're going to sort of kick this off with foundational concept overview. We'll just kind of talk some general terminology that I think Alan will be sharing throughout the meeting, so everybody's on the same page. We'll dive into what happened in 2025, look ahead at where we sit here coming into 26, talk specifically about some of the allocation and investment management decisions that Alan and his team are working on already this year. And then we'll kind of close things out with some Q&A at the end, which, as Katie mentioned, if anything comes up as we go along here, click that Q&A button down at the bottom of your screen. Send those on over. They will be anonymous. We won't be sharing those questions with the audience, and we'll try to get to as many of those as we can. So, Alan, let's go ahead and kind of dive in here. Before we get going too far, I think one of the things that we always find helpful is just to make sure that everybody is on the same page as far as some of the language and terms that we're going to talk about. And certainly here at BasePoint, when we're talking about markets, economics, performance, maybe some of the ways that we look at that and talk about that, it may be a little bit different than folks may be familiar with either from the media or other sources out there or what they've seen on Google. So I think maybe we'll just take a few minutes, make sure everybody's using the same verbiage as we go through, and that'll help with sort of the understanding here. So I want to kick this over to you. I want you to just kind of talk through, how you're looking at when we talk about performance. Kind of what's your thought process or your breakdown when we look at performance in a portfolio?
Yeah, thanks, Landis. A lot of times I think we just compare ourselves to our neighbors or our brother-in-law, but it's really important to think about performance systematically. And the really important thing we need to get to is to figure out if the performance we're getting is helping us reach our goals. So we evaluate performance in three different phases. Performance evaluation is part of the feedback phase of our wealth management process, which we've shared on previous webinars. But it's really a systematic way to look at investment returns. And we break it down into three distinct activities. So performance measurement is where we determine how much the portfolio or the index gained or lost during a specific period of time, usually a year. So for instance, you would say something like in 2025, the S&P 500 index was up 17.88%, including dividends. So that would be performance measurement. There are different ways to calculate performance. We use a time-weighted approach. It doesn't take into account the fact that money comes in and money goes out. We feel like that's a more fair way to assess performance since we don't really control the distributions or the additions to the account. The next step is performance appraisal. So that's where we determine whether or not the outcome is reasonable, adjusted for the amount of risk that we took. So, for instance, you would say something like, given our goals and constraints and considering the amount of risk that we took, 2025 returns were appropriate. And then finally, we look at performance attribution. So that tells us why did it happen? So we would look at the different components of a portfolio, and we would see which things contributed to performance and which things detracted from performance. So you would say something like our returns were affected by exposure to gold and silver, international equities, and low equity and credit risk.
Okay, great. So one of the things that we often get is questions that come to us where people are asking about market returns. And really a lot of times what they're talking about is their own personal portfolio performance or vice versa. And I think for a lot of folks out there, kind of those two phrases are synonymous, but in reality, they mean very different things. So, Alan, why don't you just kind of talk through kind of the highlights of the critical differences between when we're talking about market returns versus account performance?
Yeah, so market returns are what we see on the news, but there's some very important differences between market returns and then the accounts that we actually own. So, market returns are basically hypothetical. They're unmanaged. They're fully invested. They're cost-free. They're frictionless. And so there's no drag from cash. There's no taxes or fees. There are no liquidity constraints. There are no of those client-specific things that you want to take into account, like the stock that you inherited from grandma or mom. And there's no emotion in a market return. But we use those as a point of reference to examine whether or not the returns that we're getting are reasonable. Account performance, on the other hand, is the actual experience of a real investor. So some considerations are that those things hold cash. Our accounts hold cash. They include withdrawals and contributions. There's risk management involved. We pay fees and taxes. And they're also subject to bias and timing. So the account performance is what really matters to you. And it's also what determines your success or your failure.
Perfect. So for some people that are joining us here today, Alan, especially those that may not be clients of BasePoint, when they hear things like asset allocation or asset class, I think a lot of people are probably most familiar with those terms, maybe in the context of Morningstar classifications, right? So you've got large growth and large value and domestic equity and international equity and emerging market equity. But here at Basepoint, your philosophy really pulls this back to a much higher level asset class structure where we're really just looking at four asset classes. You want to talk a little bit about those classifications and kind of how that plays in with your approach to portfolio management?
Absolutely, yeah. So we think about assets at many different levels of granularity. There are thousands, maybe hundreds of thousands of potential investments out there in the world. But at the top level, we break them down into four major asset classes. And the first is equity. And equity is ownership in companies. It is our primary source of long-term growth. And the returns in equities are driven by earnings, valuation, and economic conditions. And it's important to remember that those have higher volatility and drawdown risk than most of the other asset classes that we look at. We look at fixed income, which are loans to governments or corporations or even people in the case of mortgages. And those are designed to generate income and to provide capital stability. So it's sort of the rudder behind the ship, but it also produces income that we can use to fund your lifestyle needs. Those returns are driven by interest rates, they're driven by credit quality and maturity. And typically, but not always, they have lower volatility than equities, but they're very sensitive to rate and credit risk. Alternatives, on the other hand, are assets that are outside of traditional stocks and bonds. And those could be strategies or they could be specific types of assets. They're used to diversify. They're also used to provide return sources that behave differently from equities and fixed income. In certain periods of time where we feel like equities are overpriced and maybe interest rates are too low, we might lean on alternatives in order to get a smoother return or a higher return. The risk and the return characteristics of alternatives vary very widely. And then, of course, there's cash, which everyone is familiar with. It's highly liquid, it's low risk, it gives us stability, it gives us liquidity, it provides optionality, and it acts as a buffer for withdrawals and rebalancing. As dividends come in, they go to cash, we redeploy. When you get your monthly income, that comes from cash. And return is a secondary consideration with cash because the primary is flexibility and control of risk. So now let's talk about portfolio management. Once we've determined what the asset classes are, then we have to decide how are we going to invest the assets. So portfolio management is broken down into two components. The first is asset allocation. And asset allocation is the primary driver of risk. So how much are going to be in stocks, how much are going to be in bonds, and how much are going to be in the other asset classes. Um, and this is where we sort of align your expected returns with your goals and constraints. This tells us where risk is taken, and we determine it on a top-down basis. So we start at the economic variables that are important. We determine what exposures we want to have, and then we move on to the second form, the second phase of portfolio management, which is security selection. And this is where we determine which securities meet the needs based on the asset allocation decisions. This tells us how risk is taken. It's valuation driven, and most importantly, it's a bottom-up analysis. And then and then finally, in the monitoring and rebalancing phase, which is the other half of the feedback phase of the wealth management process, with monitoring, we review your portfolio holdings, we review the investment markets, we review risks, and we use those to ensure that they remain aligned with your objectives, your constraints, and your policy guidelines. And rebalancing is when we adjust your portfolio holdings back to your target allocation or a new allocation after market movements or cash flows, sometimes even just the passing of time, or changes in economic circumstances and relative values.
Great. Really appreciate that, Alan. And I think, a lot of our folks on the call today, especially those that are clients, are pretty familiar with this. And I think what you've laid out is sort of a very straightforward, methodical way that you and your team are approaching the evaluation of, opportunities and risks that exist out there, and then figuring out how that aligns with the client goals and building those portfolios out. So thanks for the overview. We're going to kind of transition here. And I think what we want to start with is just a look back at what the heck happened in 2025. And I think to say it was an eventful, noisy year would probably be an understatement. We had, headlines on volatility in the markets, tariffs, interest rates, the Fed, inflation, lots of politics. It was short of the full array of headlines as we went through last year. So let's just try and dig through all that noise and maybe talk about what happened, starting with economic growth and inflation, which were really two of the biggest headlines, particularly in 2025, but really over the last couple of years.
Yeah, so we don't try to make predictions about the economy. It's a very complex, adaptive system, has many, many moving parts, but we do use economic data to determine where the risks are and to evaluate trends. So when we're trying to take that top-down approach and build your asset allocation, there are some economic signposts that will tell us where we are in an economic cycle. So looking at last year, some of the things that stand out are that many people were expecting a recession, but GDP remained positive. This was really driven by AI investment. If it wasn't for AI investment, it's possible that GDP that we would have had a recession. It's also important to note that the tariff situation caused imports to decline quite a bit. That may sound like it's a reduction in economic growth, but really what happens is since the GDP equation has exports minus imports, declining imports can actually cause GDP to rise because it's normally a negative factor. So between AI investment and declining imports, we had positive GDP, but if you look at the actual economy, certain areas actually slowed down a little bit. Inflation, which was running hot a couple years ago, has moderated, hasn't quite been solved yet. Services, and that's headline inflation. Services inflation stayed elevated. Core inflation remained sticky. And then also the data reliability has started to come under fire a little bit. There were a lot of revisions in the establishment survey. There was some disagreement between the establishment survey and the household survey. Those both determine unemployment and jobs. And then the CPI data has increasingly become more and more imputed. And in the most recent print, 40% of the data cells were actually imputed from previous data as opposed to being calculated directly at the locations. So, looking at the labor market, job growth slowed down a little bit. We saw unemployment edge up just a little, just a tiny amount. Wage growth started to slow down a little bit. We spoke earlier about all the payroll revisions that we saw. So even in the presence of economic growth, these factors provided some cover for the Fed to start declining interest rates, and then also most recently to start quantitative easing. So if I want to summarize Federal Reserve policy, they shifted from restrictive to accommodative. So we went from a rising interest rate environment and a quantitative tightening environment all the way over to declining short-term interest rates and accommodate and quantitative easing. So that has created some balance sheet expansion for the Fed, and we've been noticing more visible political pressure. I think if you look historically, there's always been some political pressure. You can go all the way back to LBJ and William McChesney Martin. But now it's actually being sort of acted out in the news as opposed to behind closed doors like it used to be. So let's move on to some of the sort of economic indicators that we look at. So the first one I want to look at are the interest rates and credit markets. So these are the primary drivers of our fixed income performance. We had an inverted yield curve, and that yield curve uninverted last year. So that means that short-term rates were lower than long-term rates. And that was a combination of short-term rates going down and long-term rates going up. It doesn't always have to happen that way. They could both be going down, but in different degrees. Credit spreads remained very, very tight. That means we're not being paid to take on the risk that companies are going to default. And we also saw some stress in the private credit markets. On the government policy and fiscal backdrop, of course, we had a new president at the beginning of the year who started a policy of tariffs. There's a little bit more economic uncertainty around tariffs. There was a lot of argument at the beginning of the tariff implementation that it was going to be inflationary. If you go back to the 1930s, tariffs seem to have been deflationary during those periods of time, and it doesn't appear that we've had inflation ignite yet. Now, some economists are saying that's because the sellers have been absorbing them because profit margins were so high and that the inflation is still to come, but that remains to be seen. We've continued to run persistent fiscal deficits. by spending more than we're taking in tax revenue, and that has caused Treasury issuance to increase. And so that's allowed interest rates to rise a little bit because there's more demand uh, for funds from the Treasury. So looking at fixed income as a whole in 2025, overall rates fell, so that was positive for our fixed income. Most of our bond returns were somewhere in the 7 to 8% range, which was significantly higher than it's been many years in the past. And that's without taking any sort of credit risk other than on the mortgage side. Credit spreads, are too tight, were too tight last year to compensate for the risk. So we mostly avoided corporate credit risk. There may be one fund that has a little bit, but it's a very small portion of our fixed income allocation. And then liquidity began to improve as the Fed eased interest rates. So if you look at equity markets, there was quite a bit of dispersion in returns throughout the year. So this might be a little bit hard to read, but the green is international, and you can see that international stocks greatly outperformed even the S&P 500 last year. The light blue is S&P 500, the purple is small cap, and the pinkish color is mid cap stocks. And you can see there was a very, very wide variance between international stocks and mid cap stocks, and we felt that too. Our most disappointing funds were all mid cap funds, and our best performing funds were all international funds, and that's a range of between 2% and 33% in the funds that we use.
And obviously there, Alan, there was a lot of volatility early on in the year, which, we haven't seen that in a few years. So do you want to talk at all about sort of, maybe what was some of the drivers of not only that decline, but also the strong recovery that you saw later in the year?
Yeah, I mean, value. We went into the year with very high valuations, and a lot of people were expecting a correction, and we had that correction. Most equity markets turned significantly negative. Our portfolios here actually never went negative on a portfolio basis, but we did have some declines from their peaks, and then as the interest rate re reduction strategy from the Fed started to pick up throughout the year, we saw equity returns start to launch off of that bottom, and we actually ended up with these returns throughout the year. But I think it's easy to forget that in April we were showing negative equity returns.
Absolutely. And certainly a lot of the early volatility, at least to the start of the year, seemed to really be constrained within a lot of those AI sector stocks that you referenced earlier.
Yeah, I mean, I think it was a combination of tariff policy. I think people began to panic about the tariff implementation, which sort of turned into much ado about nothing, at least up to this point. Of course, this is a temporal system and it's continuous, so it's going to continue going on. And maybe the impacts of those tariffs won't be seen for years, but up to this point, it hasn't seemed to have impacted the economy in a strong way. And then, of course, the AI spend has been driving the entire economy. And so that's something that we need to keep an eye on, especially as we start to get to the limits of the power generation capacity of the United States.
Yeah, so that's a good transition here. Talking about sort of that AI focus. You've talked about this, and we've talked about this on the point on the podcast a couple of times about market concentration. So you want to kind of give a rundown of what that's looked like both over the past year and really over the past several decades?
Yeah, I mean, so the S&P isn't equal weighted. I think sometimes people have this mistaken assumption that it's 500 stocks all equally split, but it's capitalization weighted, which means that the largest companies take up a larger percentage of the portfolio. And as the market gets more concentrated, of course, it concentrates risk because more and more of your assets are in fewer and fewer companies. And we're reaching the point where the top 10 companies in the S&P 500 are 40% of the assets. So if you have $100 in the S&P, 40 of those dollars are in 10 companies, and eight of those companies or seven of those companies are all completely tied to AI. So The risk return mechanism in the S&P is more skewed towards concentration and towards technology than it's ever been. And you can sort of see that in this chart that we are head and shoulders above, even going back to 1880.
And that's all fine and dandy as long as it continues on an upward trajectory, right? But that cuts both ways.
That's exactly right. So the problem with capitalization weighting is it really rewards you when things are going up, but it when that process reverses, it's much worse than what you would have in an equal weighted portfolio. So moving on to fixed income, and this is a little bit difficult to read, but it's just a chart showing credit spreads, and that's the difference between a treasury bond and a bond with some sort of credit risk, and it's broken down by risk classification. So that goes all the way from AAA, which is the best rating, all the way down to triple B, which is the worst investment grade rating, and we can see that in line with the equity drop in April of last year we had a corresponding blowout in credit spreads, but it was so short-lived, and it really wasn't. This chart doesn't. This chart makes it look much worse than it was. So we didn't really have time to deploy into credit risk. So we continue to maintain very low credit risk in our portfolios because credit really is priced for perfection. There's very little compensation for risk, and this assumes that there's going to be almost no defaults, and that recovery given defaults is going to be very high. So the opportunity for credit spreads to continue to contract is very limited. And then just looking at high yield or junk bonds, which typically pay you quite a bit more than investment grade credit, but even the high yield spreads are still well below what we would expect to see in a stressful environment. They continue to be tight, even though defaults are already going up. Defaults are elevated, and they were throughout the year last year. These spreads also disregard the fact that a lot of these high yield bonds are going to have to refinance over the next couple of years. Remember that high yield debt is usually not fixed. You don't loan um, a high yield debtor fixed rates usually. So that means at some point those rates are going to reset or they need to be refinanced. And then the triple C, which is sort of, right before you end up calling the bankruptcy attorney, is showing some real signs of cracking towards the end of the year. And we have no idea what collateral is going to be like. So that makes recovery given defaults a huge unknown. So then moving on to alternatives, gold and silver dominated. The returns in gold and silver were fantastic. Gold was up, according to this chart, 65%, and silver was up almost 150%. We went into the year having close to a 4% allocation in each, maybe even higher in some cases because they had run up the year before. And so we're looking at is that still reasonable? Merger arbitrage also outperformed fixed income. So that's when you try to take advantage of the spread between a company that's being purchased. And that produced 8.5 to 9% returns last year. Real estate continued to struggle, especially the office markets. A lot of that I think has to do with increasing interest rates because a lot of real estate debt is also variable rate debt. So they don't reset as soon as interest rates rise over time. They start to reset, and then that starts to make the properties unprofitable. And then we also saw quite a bit of stress in private equity and private credit. That sort of has a tendency to be quiet because they don't publish their results, but the word around the campfire is that private equity and private credit are both starting to show some signs of stress. And so we went into the year holding quite a bit of cash, and we were getting a decent rate of return, over 4% in many cases. That return sort of mimics the Federal Reserve lowering interest rates. And so, as you can see, the rates on cash declined precipitously throughout the year. We're still at a point now where I think we're being adequately rewarded given inflation and given the risks that are out there. But if we see many more rate cuts, we might have to start redeploying cash over into treasuries in order to pick up a little bit of yield. And we did deploy some of the cash that we had at the beginning of the year into both fixed income and international equity. This chart is really more just for illustration because I think a lot of people think to themselves, why are we talking about all this? I could just put all my money in large cap stocks and I'd do just fine. And the reason for that is because we've gone through this very long period of large cap stock outperformance. It reminds me very much of my first day on the job in April of 2000 when large cap growth had outperformed for several years. But if you look at that white box in the middle, that's an equal weighted portfolio. And while we're not equal weighted, we are diversified in all of these different asset classes. And we're trying to hit that consistent return over time and avoiding those large drawdowns in outperforming asset classes. So a lot of portfolios out there right now are 100% S&P 500. And I can't think of a time that has been more risky to be allocated in that way. And that's because if you look at these past returns, people try to extrapolate those into the future, and that's not how returns work. If you get high returns this year and earnings don't increase or asset prices don't increase, that means you're probably going to get lower returns in the future, not higher returns in the future. So in summary, I know that's quite a bit. The drivers of results in 2025, first and foremost, were equities. International equities drove returns. 33 34% returns on most of our international funds. We increased international at the end of the previous year and at the beginning of last year. That appears to have paid off. Fixed income, we were low duration. We had very low credit risk. We hit some singles there. We knocked out 7 to 8% rates of return, which helped us generate income. Alternatives were sort of the star of the show. Gold was up 64%, silver up 145%. That did cause some allocation issues because when an asset class goes up by that much, it starts to become a more dominating part of the portfolio. And then cash was boring but productive. We started the year at 4%, sort of declined as the year went on, but we did deploy some cash at the beginning of the year. And then one thing about equities, our individual equities, so the stocks that we pick ourselves did extraordinarily well in 2025.
Great. Thanks, Alan. I think that's a great overview of really what was a very, very busy 2025. Like we said, sort of in the beginning of that, a lot of headlines, a lot of noise. You've always talked about, trying to find the signal in the noise, and there was no shortage of it last year. So, um, having looked then back at 2025, let's sort of transition here. And what do you see as kind of the facts on the ground or the circumstances as they exist now that we've turned the calendar here into 2026?
Yeah, so what we just talked about was really what happened. Now we're going to talk about where do we stand right now. So when I look out over the investment horizon on January 20th, 2026, what do I see? And so a quick summary before we go through the details. In equity, we see high valuations and excessive concentration. In fixed income, we see tight spreads. We see mildly rising interest rates, and we see large fiscal deficits. And then in alternatives and cash, we see risks from metals becoming a larger percentage of our portfolio. And we see liquidity issues in private equity and private credit and declining cash rates. So digging in a little bit deeper on the current equity risk climate. So as we've said a couple times already, equity valuations remain historically high on just about any metric that you can look at. And so there's 100 different ways to evaluate whether stocks are cheap or expensive, and the majority of those are all flashing red. There's extreme concentration in the largest companies in the world that are all completely dependent on artificial intelligence. And so we have to be really careful when all of the weight is on one side of the ship. Because if AI isn't adopted at the rates that people expect, or if they run into a wall of CapEx where, they can't afford to continue the build outs, or we run out of power because we're already putting stress on our power grid, then that is going to have a big impact on both the economy and on what we consider the stock market or the S&P 500. Profit margins are starting to come under pressure. A lot of that comes from the fact that software companies are becoming more and more capital intensive. Data centers are extraordinarily expensive to build and to run. Back in the early 2000s, software companies almost had zero capex. I mean, you had research and development, but you didn't have capital expenditures in physical plant and property, and you didn't have ongoing maintenance costs. Once you publish the software, it was pretty much just you were able to continuously sell it. That's something called the network effect. But as these companies become more and more capital intensive, profit margins are starting to slip. Mid and small cap stocks remain reasonably priced. We're continuing to move some money over from the large cap and the international, from the gains last year over into mid and small caps. International equities are still less expensive than domestic stocks. So also with some pressure on the dollar, we continue to hold international equities. Fed policy is switched over from restrictive to accommodative. That should have an outsized impact on asset prices, at least in the short term. It doesn't mean we should pile in and drink the punch, because the more things stretch beyond reality, typically the worse the contraction is when they come back down to earth. So oil remains cheap. We're right around $60 a barrel. It looks like they're starting to shut down shale operations. So that might put some pressure on the price going forward. But power generation costs are surging. We've got AI, we've got electric vehicles, and we've got Bitcoin all running on the same power grid that hasn't been updated in decades. And then the tariffs remain in flux, um, pending a Supreme Court decision. So we will find out whether that's good or that's bad for markets. We did notice a large run-up in metals after the tariffs came into effect. So we'll see if there's a reversal in that if tariffs are struck down by the Supreme Court. So looking at the current climate for fixed income, we see some particular things here. The yield curve has normalized. So we went from an inverted yield curve to a normal yield curve. As the Fed lowers rates, we're seeing the long end of the curve actually rise. So the yield curve is also steepening. Real rates have continued to remain positive. That means we're getting paid more on bonds than inflation, given the calculation that they use. Now, again, there's some questions about whether CPI is accurately reflecting what we're really spending. But given the data published, real rates remain positive. Short rates are declining. Credit spreads continue to be very tight. Defaults are starting to tick up. Mortgage rates are high by modern standards, and as the 10-year continues, if the 10-year continues to rise, mortgage rates will continue to go up, which will put pressure on housing sales. And then private credit is sort of quietly under stress. We're seeing more payments in kind, which means that borrowers don't have cash. They're just issuing more debt. That creates some significant problems for the funds. And then our fiscal deficits are continuing to expand.
Alan, I want to take a second here. As you're talking about fixed income, and you mentioned mortgage rates in here, and the Fed is, kind of under a rate cutting cycle. I think maybe at times people wonder, why is the Fed cutting rates, but yet we're seeing mortgage rates sort of remain sticky in that 6.5% range, or high five range. You want to talk about that a little bit before we move on to the next?
Yeah, so the Fed controls short-term interest rates, overnight rates. And so, yields typically exist on a curve. They're not a straight line. Mortgages are priced based off the 10-year treasury. So there's a big difference between what someone is willing to lend money for overnight versus 10 years from now. And as the Fed reduces short-term rates, that puts pressure on expected inflation. And if you expect inflation to be high over a 10-year period, you're going to demand more money for lending over that period of time. So as the Fed cuts rates, it builds more inflation premium into the 10-year bond, which then that's what mortgages and auto loans and credit cards and all those other things are priced on. So the rates that we really pay continue to go up because it puts pressure on the inflation premiums. So moving on to the alternatives and cash. So it would be difficult to expect the same returns from metals that we've received that we got last year. Not that it's impossible, but if returns are similar to last year, I would expect it to be a sign of some sort of economic calamity, not just simple price appreciation. There are some mechanisms, especially in the futures market. There's significantly more paper metal than there is physical metal. We're seeing deliveries increase in Shanghai, which is creating a spread between the price of buying actual metal and futures on metal. Those things are all technical and structural, though. We wouldn't buy or sell based on that. We were only buying or selling based on the amount of risk that we want to take. but there is the possibility of some sort of outsized move in metals based on those technical structures. But as far as just basing it on what type of goods you can buy with a certain amount of metal, there's very room for appreciation under that scenario. So merger arb will continue to benefit from government policy and liquidity. Uh, the government continues to be accommodative to antitrust and mergers. There's ample liquidity out there right now, at least on the surface. Real estate continues to be pressured by rates. There's shifting demand. There's tightening in lending. So we may still see, especially office and shopping centers, that type of stuff have pressure on the real estate side. Private equity is sort of facing some liquidity concerns and some valuation concerns. They don't mark their returns to market, so things can sit on their balance sheet at prices that are sort of unrealistic. And so the problem with that lack of volatility over the short term is that a lot of times the volatility comes all at once. And then cash remains a viable asset, but we need to watch the rates. And if we start approaching that zero bound again, we'll have to find some other use of cash, probably more merger arbitrage or more short-term treasuries.
Awesome. Thanks, Alan. I think that's a great look at kind of where you see things as they stand today. So probably the big burning question that people have that are tuned in today is, all right, so we heard what happened. We heard where things are at. So what exactly are you going to do about it? So you want to talk us through what's kind of in your mind and what your team's working on today?
Yeah, sure. But first of all, I think it's important to reiterate that, we're sticking to our principles. We're principles based and we're process oriented. Our principles remain relevant. They're most relevant when they seem like they're out of step with times. We continue to base everything that we do on fundamentals, on actual cash generation, whether that's at the earnings level or the dividend level or the interest level. We don't buy things just because the price fluctuates. We don't sell things because the price fluctuates. It's always based on research. And we continue to be disciplined. We continue to know what we own. We continue to try to look at the most granular level possible, and judge actual cash flows, not, at the index level or at the asset class level. And then, we always stay factual. We don't run with the herd. We don't try to buy things just because someone else is going to buy them. We only base what we do on what we know. So positioning for 2026. We'll be very selective in U.S. equity markets. We'll probably move more from the large cap down into the small and mid cap area. Small and mid cap underperformed last year. I know that feels counterintuitive, but that means that the growth in the companies was not matched, by the price increases. We'll continue to hold energy, even though the price of oil is low. We feel like there's going to be pressure on energy. We'll continue to hold international stocks. We'll probably use a few more individual stocks if the valuations continue to decline. It's important to note that even though the market showed high returns last year, there was a great deal of dispersion, which means that a lot of companies that are actually good companies and well-run businesses underperformed last year, because most of the returns were concentrated in those 10 AI stocks in the S&P 500. So there are pockets of great value out there that we can get exposure to. We're going to continue to keep interest rate and credit risk low. We're already seeing the long end of the curve sort of slip a little bit higher. Credit spreads are way too tight, so we would look for some sort of credit spread event in order to add any sort of credit risk. We'd need to see a couple hundred basis points blowout in spreads in order to entertain the idea of adding credit risk. So we're probably going to stay in treasuries, inflation-adjusted bonds, mortgages, and then, if we have some sort of spread expansion, then we'll evaluate whether or not we want to add credit risk. We are going to rebalance our gold and silver exposure just because with the run up, it's become too much of a percentage of portfolios. It's one thing to have 4 or 8% in metals, but it's unacceptable to have 16 or 20% in metals, just because it skews your risk. Those metals are still highly volatile. There's nothing stopping them from dropping 50 or 80% at any given time. And so it's purely risk management. It's not a prediction about what the prices are going to do because we don't know. And then if rates continue to decline, the rate we're getting on cash will continue to decline. And so if we see cash rates get down to a point where we're not keeping up with inflation, we'll have to redeploy either into alternatives or into short-term treasuries.
All right, great. Alan, I think that's kind of a good overview of, sort of the things that you're looking at right now. So I know we've covered a lot of ground today. Let's just maybe take this moment. I think it's a good time to sort of circle back through this, and maybe folks out there, if they've got questions that are starting to brew, now would be the time to start submitting those in. Uh, let's just kind of go back and, in summary, what's the big picture that we're looking at here?
So, there's absolute returns and then there are relative returns. Absolute returns is what is the rate that we got. Relative is how did we do compared to everyone else. We had very strong absolute returns, double digits in many cases, in most cases, really. Most of our clients need between 4 and 6% for their money to last forever. In many cases, we doubled or even tripled that. Those are very strong absolute returns. Our relative returns were acceptable. It was a year with very high market returns. Interest rates dropped throughout the year, so 60/40 portfolios had high returns. Even though we were avoiding most of the things that drove those returns, we still sort of kept up with them, and we were acceptable because we controlled risk. Like I mentioned earlier, during that period of time in April when the market went negative, almost none of our portfolios went negative during that period of time. Only the most aggressive portfolios ever showed a negative return. It was a nice little litmus test to see how we're positioned. So, when we capture a lot of the upside and we capture very little of the downside, that's really what we're looking to do with portfolio management. So, just to summarize a couple of things and to review a couple of things that I've already mentioned a couple of times, our individual equities performed very, very well. They had underperformed the year before, but when you buy based on cash flow and you buy based on earnings, over time, those earnings typically tend to shine through. So last year was the year that our individual equities actually sort of contributed to returns. Our mutual funds did lag, especially our mid caps. I'm not concerned about that because, as you saw earlier, mid cap underperformed everything. They're still buying companies based on reasonable principles. They're concentrated. They're well-run businesses, and the fact that they didn't perform well last year gives us an opportunity to maybe make up for some lower returns in other areas. International drove returns. Again, we mentioned that before. It was double-digit returns in international. Out of 5 international funds, 4 of them performed almost over 30%, and that includes international large, international small, emerging markets. All of those did really, really well. Metals were the star of the show, as you know. So we'll be looking to rebalance those. And then our fixed income returns were solid. In a area of 4% interest rates, we were getting 7 or 8%. That tells you that rates sort of declined throughout the year, and it contributed meaningfully to our returns. So it just goes to show that risk management works. You don't have to buy the index and sit on your hands in order to get good returns that have low risk. Our equity risk stayed moderate. Of all the assets at Basepoint, only about 50% of them are in stocks right now. So we're taking very little equity risk, even though we had very high returns. Our credit risk continues to be very, very disciplined. So if defaults pick up or bankruptcies, that should not have a very large impact on our portfolios. And then throughout this entire period of time, we maintained a lot of cash. So if there is some sort of credit spread event, or if there's an equity market correction, we have a lot of cash to deploy and put to work. And we will look forward to doing that. So the actual moves that we're making, rebalancing the metals exposure, maintaining the disciplined equity posture, more individual stocks, more mid, more small, trimming the large cap funds a little bit, and then keeping some of that cash so that we're flexible. What cash feels like it's a detractor, it's really a call option on future prices. And as we saw in 2022 when we had a lot of cash and interest rates went up a lot, while the rest of the world was taking 40% losses on their bond portfolios. We had no losses, and then our rate adjusted from 0 to 5% without any pressure on the portfolio. So what we welcome going forward, this isn't necessarily a wish list, so I don't want to scare you. But we're not afraid of equity volatility. We would welcome equity volatility. That just gives us an opportunity to deploy capital at better prices. We're very disciplined. We're only buying based on earnings and based on dividends. So equity volatility doesn't bother us. And again, we only have about 50% total portfolio exposure to equity. We would welcome a credit repricing. I would love to be able to buy more corporate bonds and get a little bit of pickup on yield over treasuries. So credit, we have very low credit risk. So, a credit expansion does not scare me at all. And we would look forward to valuation discounts, right? So equity volatility, credit repricing could lead to better prices. And those better prices just give us higher future returns. And then the things that will remain the same, we will continue to be relentlessly long-term focused. My goal is to make this money last as long as you need it. I'm not trying to beat quarterly bogeys. I mean, that's a fool's errand. It's the surest way to lose money in markets. We're looking at the next 5 or 10 or 20 years of your life to make sure that these assets are here when you need them. Our valuation discipline will remain steadfast. We won't buy things just because they've been going up. We won't buy things just because they're popular. It's always based on how much we're earning in relationship to the price that we're paying. And even though we're relentlessly trying to get you higher returns, we will make risk-first decision making, which means the first question we ask ourselves is, what happens if things go wrong? Is there an opportunity to permanently lose capital? Are we looking at, a 50% potential loss here that's going to impair your ability to continue to be retired? There's nothing worse than sitting across from someone and telling them they have to go back to work because they lost a bunch of their money. And unfortunately, early in my career, I had to have that conversation with people, and we're not going to do it again.
Awesome, Alan. I think that's just a great outline of the discipline and the thoughtful approach that you've always taken in your role as the chief investment officer, and you and your team do a great job of really trying to stay steady on the ship, no matter what's getting thrown our way and what's coming our way in the headlines, and hopefully going through that really kind of reinforce some peace of mind for the listeners here today. So appreciate all of that. We're going to go ahead and transition over into the Q&A segment of today's webinar. As we mentioned earlier, please submit any questions using the Q&A feature at the bottom of your screen there in Zoom. We have had a few questions already come in. Just kind of a reiteration to, if you have specific questions about holdings in a personal portfolio or your own accounts, your own situation, please be sure to reach out to your advisor or send us a note offline, and we'll handle those kind of one-on-one, as opposed to doing that here in the public forum. I think maybe one of the first questions that we can get to, Alan, you talked a fair bit in here about how strong equities have been. And so there's a question that has to do, in a nutshell, why aren't we deploying more into equities? Why not take more risk now if equities have been so strong, especially if cash is sort of maybe losing a little bit of momentum as interest rates drop?
Well, I think the most important thing is that strong returns are typically, not an indicator of future returns. So, whatever did the best last year isn't necessarily what's going to do well next year. So, that's one of the reasons why we illustrated that quilt chart, to just show that, the leader changes over time. And then when I look at the current landscape, it doesn't really have to do with the fact that returns were high. It has to do with valuations, right? So we have high valuations. We continue to have a lot of concentration risk. Our goal is compounded returns over time, minimizing losses, and getting you the highest return we can over a decade, not trying to beat the neighbors for last year.
Perfect. And then I've got another one here, kind of along the same lines. You mentioned several times in this presentation, and going back over the past few years as we've done market reviews or whatnot, this hasn't really been a talking point, but it has to do with international equities, which, as you mentioned, were kind of one of the stars of the show. But the question is, why exactly have international equities worked better than U.S. equities this year? And I'm just going to kind of give a little bit of context to that. For a number of years, you and your team had very minimal allocation to international equities. I think you mentioned earlier in the presentation that was something that you really kind of expanded that positioning late in 2024 and early in 2025. So maybe just talk a little bit more about the decision on why those came in and then why we saw such strong performance internationally relative to US markets.
Well, it all comes down to valuation, right? Just like everything else. Over the last few years, with that outperformance in U.S. equities, non-U.S. equities have become much cheaper in relationship to U.S. equities. So, it's really about the earnings yield that we're getting, not about any sort of prediction of what should do better. And, it didn't change right away. There was a year or two in there where international equities were priced much better than domestic equities when we started buying, and we still underperformed a little bit. But last year's where that valuation gap started to close. On the non-US side, there's also a lot less concentration in, a handful of giant cap technology companies. And then the dollar has run into a little bit of a headwind. So when the US dollar depreciates, it makes foreign currencies go up. And so when we buy equities that are denominated in foreign currencies, we get a little bit of a bump there based on the currency spread.
Okay, great. I had a question come in here, and we touched on this earlier in the presentation, uh, but the question was, please explain again how lower Fed rates cause higher mortgage rates. Uh, and I brought that up, and I think you did a good job answering it during the presentation. But I think that's a question that we get a lot of times, and so I think it's one of those things of helping people really understand the connection between what does the Fed actually control versus, what are the things that are most likely to impact our clients out there or the public in general. So do you want to just kind of go back through that again, Alan, and just
Sure.
kind of talk about, there's a lot of noise around the Fed, a lot of maybe pressure on the Fed to make certain decisions, based on whatever politics or views that people may want to have. But that doesn't necessarily drive what ultimately impacts us as consumers. So maybe just go through that again for our listeners.
Sure. When the Fed says we're lowering rates, they're talking about overnight rates, very, very short term. They have no direct control over longer term rates. Those are set by markets. So if you think about an overnight rate and a 10-year rate, you have to build a couple of premiums into that rate. And that's typically why we see longer term rates uh, higher than short term rates because you've got additional premiums built in there. You have liquidity risk, you have inflation risk. And so what happens is when the Fed drops rates, that means the economy is running hot. That means that the inflation premium is typically going to increase, right? So in order to borrow money, I'm sorry, in order to loan money for 10 years, we're going to want more inflation premium in order to make up for the fact that the Fed is sort of running the economy hot. And when your mortgage is priced based off the 10-year, that inflation premium is getting built into your mortgage rate. So it has to do with what they can control and what they can influence. Now, they can influence long-term rates by buying bonds. So they go out into the market, they buy bonds, and sort of take them off the market. That can cause the rate to drop. And so then there's extra liquidity out there that causes people to move out on the risk curve. That can indirectly cause the longer term rates to drop. They started that last month. So we may see the long end of the curve start to come down based on that quantitative easing.
Excellent. Uh, we'll take a couple more questions here that came in. Received one question in here, kind of linking into the inflation piece that you just mentioned there. But it says one of your slides had mentioned immigration, and I think that was back on our government policy slide. And the question is essentially, what's the linkage between immigration and inflation, or immigration policy and inflation? And I think obviously there's a lot of media attention right now on this topic for a whole host of reasons out there. Um, but maybe one thing that doesn't get talked a lot about is sort of the economic and by extension, maybe market impacts of immigration policy. So do you want to touch on that a little bit?
Sure. Yeah. And it's not political at all. It's purely mechanical. So, when people are coming into the country, we have more consumers, we have more workers. Those people are able to be employed, so they fill jobs. When people are leaving the country, we have less of those things. So, having less immigration and having more people moving out is disinflationary because we have less consumers, we have less economic activity, and so it could moderate inflation.
Okay, perfect. I know during the presentation you kind of briefly alluded to the dynamic between the administration and the Fed, particularly around sort of policy. You know, we got a question that came in here about essentially the power of, in particular, the presidency or the executive branch over influencing the broader economy. Um, Maybe can you just share a little bit of context of that relationship? Because I know you mentioned in the presentation that a lot of the back and forth between the administration and the Fed has been very, very public, but that's not necessarily new. So, do you want to maybe touch on this a little bit?
Sure. I mean, there are a couple of different levers where the executive branch can influence the economy, especially when they're interacting with the Federal Reserve. So that sets interest rate policy, at least short-term interest rate policy specifically. They can affect immigration policy, which can affect inflation and economic growth. They can affect the antitrust environment. So, are they allowing mergers to take place, or is the Justice Department shutting down a lot of mergers? They can add regulations or they can remove regulations. So, the more regulations you have, the more restrictions you have. That sort of acts as a little bit of a slower like pouring molasses in the gears because it takes things longer to have happen. They can affect energy policy. So are we going more towards clean energy? Are we going more towards drilling? Are we going to open up certain areas for drilling, or are we going to have incentives for clean energy? So all of those sort of things are ways in which the executive branch can interact with the actual economy. And I don't really provide grades to administrations. I just respond to the things that I see. And so, right now what we have is, we have sort of a disinflationary environment in the fact that we're, reducing immigration. We have a shift in energy policy towards more traditional energy sources. We have sort of a lower regulatory environment, so we're removing regulations and making things easier to get done. And so those things, if you were reading them in a textbook, would say that they should be good for an economy. But they don't happen right away, right? It takes years for them to play out. So, the textbook definitions don't always translate into real world outcomes.
Perfectly threaded. Well done, sir. Uh, I've got kind of a closing piece here, and this came in from a couple of different folks. So I'm going to sort of put these together because people love you, man. You do a great job with this stuff. And so there's one little piece of feedback in here. Said they don't have a question, but wanted to convey that they really appreciate the principle and discipline that you and your team have in managing the investments. It's a matter of trust. So I think I wanted to share that and make sure you heard that. I know you just love compliments. So
Yeah, I'm blushing. Luckily, there's no camera.
perfect. And then we did get a question. I think this is a good one. Question was, Alan, how long do you plan to be at Basepoint, and what's your succession plan for your role?
Well, my wife would tell you I plan on dying at my desk. So, this I don't do this because I work here. I do this because I love this. This is my passion. It has been since I was in my 20s. I'm in my late 40s now. So no plans for retirement. Obviously, there's always things that we can't control. And so right now I have three analysts that work directly with me. We spend all our time talking about this stuff. I've got a very specific list of things I'm trying to teach them, both on the asset allocation side, on the security selection side, drilling the principles. We read a book every month to try to, get all of that stuff that I've jammed into my head over the last 25 years into theirs. And hopefully in 10 years, they'll be where I'm at, and then they'll be able to pass me up and do an even better job than I've done. So that's the plan.
Outstanding. All right, Alan, I think we've gone a few minutes over. We really appreciate everybody taking the time to join us today. And as mentioned earlier, we hope at least some of you will join us on the Point podcast or on our quarterly updates moving forward.
Thank you for attending the Basepoint Wealth Investment Update and Outlook webinar. If you have any questions, please contact your advisor directly or call us at 319-826-1898. Have a great afternoon.